If someone handed me $10,000 today and said, invest this wisely, I wouldn't start by looking for the hottest stock. I'd start by building structure because investing isn't about finding the perfect pick. It's about building a system that works over time. Good morning. Today I'm going to show you a simple way I would structure a $10,000 investment portfolio if I were starting right now. Not complicated, not risky, just structured. Let's break it down. Step one, start with broad market exposure. The foundation of the portfolio would be a broad market ETF, something that tracks a large portion of the stock market. Why? Because broad exposure captures overall economic growth. Instead of trying to pick individual winners, you own a large portion of the market itself. If I had $10,000, roughly $5,000 to $6,000 would go here. This becomes the engine of long term growth. Step two, add international exposure. Most investors concentrate heavily in their home market, but global diversification matters. Different economies grow at different times. Adding international exposure reduces reliance on one country's performance. So I would allocate roughly $1,500 to $2,000 toward a broad international ETF. This spreads risk across multiple global markets. Step three, add stability. Even small portfolios benefit from stability. Volatility can cause emotional decisions, and emotional decisions damage returns. A stability layer, often through a bond ETF or defensive asset, reduces overall swings. For a $10,000 portfolio, about $1,500 could serve as that stabilizing layer. This isn't meant for excitement, it's meant for balance. Step four, add income or real asset exposure. The final piece could be a small allocation to income producing assets. Examples might include dividend focused ETFs or real estate investment trusts. This introduces income potential and additional diversification. For this piece, about $1,000 to $1,500 could work well. The midpoint truth notice, something important. This strategy isn't about prediction, it's about preparation. You're not trying to guess the next winning stock. You're building exposure to multiple economic drivers. Growth, global markets, stability, income, That balance reduces fragility. Why simplicity wins many investors complicate their portfolios. They add too many funds, too many strategies, too much noise. But complexity often leads to overlap. Overlap increases concentration, and concentration increases risk. A simple structure is easier to maintain, and maintenance matters because investing success isn't built in one decision, it's built through years of consistency. Final thought: if I started with $10,000 today, my focus wouldn't be on making it grow fast. My focus would be on building a system that allows it to grow steadily for the next 10, 20, or even 30 years. Structure first, returns later, because structure protects discipline and discipline protects compounding. If this helps simplify how you think about investing, subscribe, because here we build portfolios designed to last.